All right, Mike. So today we're talking about keeping track of home improvements so that when you go to sell your home later, you have an accurate picture of your cost basis in the home, which may in turn reduce your taxable capital gains.
Yeah. What we sometimes see is that people spend hundreds of thousands of dollars improving their homes, then throw away the receipts and forget about it completely. And that can be a costly mistake when the house is eventually sold.
Yeah, well said. Many homeowners don't realize that certain improvements can increase your cost basis in the home, which may reduce taxable capital gains later. We always advise that better record keeping today could potentially save meaningful taxes down the road.
Exactly. We sometimes hear people say, well, I'm not selling anytime soon, so I don't need to think about this yet. But that's actually why this often gets missed.
Yeah, it's important to keep track of home improvements as they happen, rather than trying to piece together everything years later when you're preparing to sell. Keeping receipts, invoices, and a simple running list of projects can save a lot of stress down the road. But let's back it up a bit and start simple. What exactly is cost basis in the context of your home?
Yeah, you can think of cost basis as your tax starting point, what you paid for the house, plus certain acquisition costs. Then over time, qualifying capital improvements can increase that number, creating what's known as your adjusted basis.
So let's say you buy a house for $1 million. Your cost basis is roughly $1 million plus certain closing costs. If you later spend money on qualifying improvements, that amount gets added to your basis.
And the reason this matters is because when you eventually sell the property, your gain is calculated by taking the sale price and subtracting your adjusted basis. So the higher your basis, the lower your taxable gain.
Exactly. So let's put some numbers to it. You buy a house for $1 million. Years later, you sell it for 1.6 million. At first glance, many people would look at the numbers and assume they have a $600,000 taxable gain.
But say over the years you added a new roof, renovated the kitchen, and redid flooring, and qualifying improvements come out to 150,000. When those improvements are properly documented, they're added to your initial cost basis.
Right, so now your adjusted basis becomes 1.5 million. And instead of a $600,000 taxable gain, you're looking at a $450,000 taxable gain.
Yeah, that difference matters, especially because not every homeowner qualifies for the full capital gains exclusion.
So let's talk about that because the home sale exclusion is where people often get confused. Some homeowners might have heard that you can sell your home and pay no taxes because of the home sale exclusion, but it's not always that simple.
In some cases, homeowners may be able to exclude a portion of the gain from taxes if certain ownership and use tests are met. So generally speaking, that means owning and living in the home as your primary residence for at least 2 of the last 5 years before the sale. If you qualify, you may be able to exclude up to 250,000 of capital gains if single and 500,000 of capital gains if married filing jointly.
And for many people, that exclusion covers most or all of the gain, but not always. So let's walk through an example.
Let's say a married couple bought a home years ago for $1 million. Over time, they put 200,000 into the qualifying improvements, landscaping, HVAC system, and an addition to the home. That means their cost basis may now be around 1.2 million. Now imagine years later, they sell the home for $2 million. At first glance, someone might think we made $1 million, so we owe taxes on all of that, but it's a bit more nuanced.
That's right. Because first, your basis matters. So if the adjusted basis is 1.2 million, the gain may actually be closer to 800,000 before factoring in selling costs like realtor commissions and closing expenses. Then, if this married couple qualifies for the $500,000 home sale exclusion, a significant portion of that gain may be excluded from taxes. In that case, they'd only be on the hook for $300,000 of taxable capital gains.
This is also why keeping track of home improvements matters. Projects that add value, prolong the home's useful life, or adapt it to new uses may increase your cost basis and potentially reduce taxes later. But routine repairs and maintenance generally don't count.
Exactly. The key takeaway, the home sale exclusion is valuable, but it doesn't automatically mean every home sale is tax-free. Knowing your basis and keeping good records can make a meaningful difference. So let's talk about what actually counts as a qualifying improvement when it comes to increasing your adjusted basis in your home.
The IRS generally says an improvement must do one of 3 things: add value to the property, extend its useful life, or adapt the property to a new use.
Right, so some common examples that generally qualify are room additions, kitchen remodels, bathroom renovations, new roofs, windows, and permanent flooring.
Yeah, think projects that materially improve the home, not cosmetic maintenance.
But yeah, that's a good point. Now let's talk about what people often incorrectly assume counts.
Yeah, things like routine repairs and maintenance generally do not increase basis. So things like fixing a leak, patching drywall, painting a room, replacing broken hardware, things like that.
Yeah, this is where people get confused. A repair restores something, an improvement upgrades something.
Right. So replacing part of a roof after storm damage, usually a repair. Replacing the entire roof, much more likely to qualify as an improvement.
Yeah, so here's the practical advice I typically give clients. Create a digital home improvements folder the day you buy your home. Or if you already own a home and you haven't given this much thought yet, today's a great day to start.
Yeah. So inside that folder, save your original closing statement, contractor invoices, receipts, permits, and before and after project details.
We normally also recommend keeping a running spreadsheet and including in that spreadsheet the project date, description of the project, the contractor who you outsource to do this work, and the cost.
Because realistically, no one remembers this 15 years later, and the IRS is not going to take your word for it.
Yeah, let's be honest, nobody enjoys saving paper receipts for several years. But if you spend just a few minutes scanning, uploading, and organizing your receipts as they come, you could potentially save thousands in taxes when you go to sell. It's a pretty good trade-off.
Yeah, a lot of people put meaningful money into their homes and never document any of it. Then years later, when it's time to sell, they're scrambling, trying to reconstruct expenses from memory, old emails, bank statements. So future you will thank present you for creating a home improvements folder to accurately document and adjust your cost basis over time.